Podcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Bobby Rains here for our once every 3-week Investors Observer members only workshop. We've got our usual agenda this week. We're going to talk about what's going on at Investors Observer. We got a little market update, and then the rest is member-driven content, questions, site demonstrations, etc. So any questions you have at any point, you can go ahead and put in the question box today. I usually have that open on the side over here somewhere so I can see them as they come in. And so, if you have a question about what I'm talking about right now, put a question in the box and I'll try to get to it as it makes sense. Otherwise, you can put questions in and they'll just be queued up for the end. You can, of course, send questions in ahead of time. Just mention workshop, and then I can put together slides or talking points or something like that ahead of time also. All right, so we don't have a lot of new updates about what's going on in Investors Observer this week, so let's get to the rest of it. This is 2 years of one-day candles on the S&P 500, and we put some moving averages in this time. A chart with about 3 different candles on either end was in Friday's this past Friday's week in review post that we put up Friday afternoon. We've gotten back a little bit closer to the 200-day moving average, which was kind of what we were pointing out at that point, was the difference between where we are now and the 200-day moving average is the biggest it's been in the last 2 years. It's not necessarily indicative of anything other than being pretty far away from the 200-day moving average, but when things start to look stretched like that, you do start to wonder. They can certainly and have in the past been more stretched than that, but it is the sort of thing people might keep an eye on. We'll go to 6 months here so we can just see everything a little bit better. It's still, you can really see how stretched it is. You can see back here, this is, this area from most of last year where we, started the year with a big run up and then didn't go very far. So this is where we really have good support if the market were to fall, although there are some levels between here and there. Wouldn't necessarily expect it to go all the way back to, that just up from 3,000 level if we did get a little bit of a sell-off. All right. What else is going on? On the trade front, I think sort of where we are right now is where we're going to be for at least the rest of the year on China. I don't think there's a lot of political will to do much more there. So it's not getting any worse, and it kind of is what it is for now. So the people who are paying tariffs, especially businesses, are just going to have to live with that for now is how I think it's going to go. Europe, there's some other interesting stuff going on. France in particular has some new taxes on like digital services and things like that the president isn't super happy about. And he's threatened to put tariffs on basically the entire EU. There are ways to target those, right? Like you can put wine tariffs on the EU and it hits France pretty hard, and then Spain and Italy less hard. But yeah, so that could be interesting. The Europeans would probably retaliate if that happened. But it'll be interesting to see if the president actually wants to do that in an election year. My suspicion is probably fewer of those things will happen the closer we get to the election. But at, well, let's call it 10 months out, it still seems like it's possible it could happen. The Fed concluded their 2-day meeting today. They said they're not going to change anything. They want evidence that things are changing in one direction or the other. The repo balance sheet operations could get interesting, but they said Powell said he plans to continue those into the second quarter. So we're talking somewhere between April and June before that ends up being an issue. So I don't really see that being a big impact right now. I know the market sold off a little bit after he talked today. I'm sure someone will construct a narrative about why exactly that happened, but you know, a lot of times the market does one thing immediately after he speaks, and then it reverses by the end of the week. So we'll see what happens there. Economic data continues to be relatively stable. Every once in a while, you'll get a report that seems really good or really bad, but on the whole, it's just been relatively consistent. The Fed, one notable thing from their talk today, let me fix that typo, downgraded their assessment of household spending from strong to moderate. There we go. Yeah, that's much better. All right, downloaded their assessment of household spending from strong to moderate, which I don't think is particularly significant unless it gets downgraded again the next time, at which point you have a trend, but I don't really think that's that big a deal. Now, going back to China, the virus thing will definitely hurt China's economy. You know, people tend to sell stocks in a panic, and that's what we saw late last week, earlier this week. But the actual impacts get pretty hard to measure at this stage. Obviously, the longer we go on, so the longer the crisis part goes on, the bigger the impact will be. There were some, epidemiologists earlier this week who said, man, this might not be a thing we can contain, and it might just be a thing that's out there. At which point, at a certain point, people stop panicking and go about their lives, and then it stops being a crisis. So it's not necessarily the longer the virus exists, the worse it will get for stocks, but the longer the crisis part goes on. Right now, the things that are affected pretty heavily are airlines that are cutting flights. Right? Yeah, if you're just canceling business, you're not, you're giving away money there. Starbucks closed a bunch of its stores in China. Those are the kinds of things that will show up in the bottom line. Google is closing offices in China, but Google already has a lot of remote employees. I don't know how much impact that actually has on their business. As this drags on, if factories stay closed and things like that, then you could see some impact on global supply lines, things like that. But right now, honestly, the 737 Max is a bigger hit to the the U.S. GDP. It's I think somewhere around 0.5 percentage point, whereas this right now, I mean, yeah, if this cleared up by the end of next week, I think we'd probably go back to normal and things would be fine. I don't know how likely that is to happen. But for right now, it's really hard to measure what the effect on the U.S. markets will be. All right, so that's that. We got a couple of questions ahead of time this time. Actually, the first slide here is catch up from the last session. We got a bunch of questions in the last workshop about rolling sold calls, and I talked about it a little bit then, but I wanted to kind of put some of those thoughts down on slides. So we'll talk about that today, and then we have another question we got as well. All right, so the questions last week were about rolling sold calls and sort of how it works and why, why you do it. So how it works is pretty simple, right? You have a sold call in, say, a covered call or a diagonal spread. And what you do to roll it is you buy back the call you sold and sell a new one. That's pretty simple. Now, the things you want to be mindful of there are your break-even point, right? So for covered calls, the break-even is just the net debit, right? The amount you paid to buy the stock minus whatever you got for signing the option. You can also back, if you sold several options, you can take all the option prices out of it. You can take dividends off of that too if you were so inclined. For diagonal spreads, the break-even stock price, what we like to use is the bought call strike price plus the net debit. So that means if you bought a $60 call and you paid $40 for it, let's say, or $40 for your total diagonal spread, your break-even stock price is $100 at that point. It's 60 plus 40. And so the reason you want to keep track of that break-even point is if your strike price is below your net debit, you are potentially going to get locked into a loss there, right? If you have, let's say, in that diagonal spread, if you had that $100 break-even and you sold a $99 call against it, well, now your call can be assigned at 99 and you're going to get $39 out against a $40 cost basis. That's going to be a loser every time. Covered calls, it's a little bit different just because you have the bought strike, or you don't have a bought option there, but the principle of if the net debit is higher than your strike price, you're probably looking at a loser there. So the other thing you want to think about is, can you roll for a credit or a debit? Rolling for a credit means that the price of the new option you're selling is less than the price of the new option you're selling is more than the price of the option you're buying back, right? So you can buy something for a nickel, sell something for a dime. You have a credit there. That turns out it lowers your break even, right? Your net cost of owning the whole trade goes down in that case, whereas rolling for a debit will raise the break even. So one thing to consider there. Well, let's do the next couple. Yeah. Okay. And so the other things you can consider are rolling up versus rolling down. And up and down here refers to the strike price. So, going from 100 to 101 or 100 to 99. 100 to 99 would be down. 100 to 101 is up. So up, you're less likely to gain a credit, but it does raise the target profit. Down or sideways is more often going to be for a credit, but rolling down can lower your target profit. So if you roll from 100 to 99, right, you just took $1 off of your potential return. Now, if you roll from 100 to 99 for $1.20 credit, right, you actually added 20 cents there. But yeah, so that's a thing to look out for. Rolling up in particular is a thing where it may seem, counterintuitive to roll it up for a debit, but if you think the stock is likely to keep going, and you can roll up for, if you move the strike price up by $1 and it costs you less than $1 to do that, well, that difference between whatever your debit is and then, how far you move the strike price potentially flows to the bottom line. It does put more at risk in the moment, but potentially you can get that back plus more, if the trade works out for you. Rolling up also will typically lower the probability of being assigned. So if that's the thing that you're concerned about, that's another reason to do that. All right, and the reasons to do this are, essentially position repair. Right, you have a trade that's a loser. You want to get rid of the call you sold against it and sell something with a higher premium to lower that break-even point. That's the one through it. That's what we do in our portfolios here most of the time. There's been a time or two where we've had an opportunity to roll something out a week or so, just to keep it open to capture more profits. But I don't usually do that, just because if I'm gonna go make a trade, I usually like to start my process from the beginning and find the best trade for today, as opposed to, I can change this trade around a little bit and keep it open longer. But that's personal preference. I think your, styles and tax reasons may suggest other things can be appropriate at different times. But yeah, so that's kind of some thoughts about rolling sold calls. Really what you want to keep track of is that break-even point and your strike price. As long as you keep those in the right relationship to each other, which is break-even lower than strike price, you should be good to go. All right, so the next question we got. So let me. hit some of this with some italics here. There we go. All right, just to separate the question from the answers. So does an option price change drastically when the underlying price changes during the day because of theta lost in time value? Also, there's some questions about supply and demand. And the example he gave was Lam Research, which announced earnings on Friday, and the turns out Friday expiring 260 put is moving too fast, and then ends up losing value at the end of the day. I'm not sure, but there may have been a bull put spread in our portfolio. I'm not sure. It may have been an investor's keyhole trade. It hasn't been in the portfolio for a while. I've probably done it before, but I don't remember exactly. So essentially the question is about option prices. And yeah, so Lam Research is $300 as of earlier this afternoon. So 260 put is pretty far out of the money. And then also, yeah, it's an option that has 2 days left till expiration at this point. So it's very short dated, pretty far out of the money. And yeah, those are going to be pretty volatile. So part of that is theta. And the thing is, right, like if you think about it, an option with a week to go lost 20% of its time value on Monday. Tuesday, it lost 25%, right? I mean, if you count from Monday morning to Monday afternoon, that's 20%. From Tuesday morning to Tuesday afternoon, that's 25%. From Wednesday morning to Wednesday afternoon, that's 33%. Tomorrow, it's going to lose 50% of its remaining time value, and then Friday, it'll lose 100%. Those end up being pretty small amounts in dollar terms. The theta for those, when I looked it up earlier today, was at 0. Which just means it's less than a penny. But at a 20% option, those are pretty big percentages. The delta on this guy is also super low, but if you remember, delta means the price in dollars change in the option for a dollar move in the underlying. So for a $300 stock, a $1 move is only 1/3 of a percentage point. And so, even if it has a delta of 1, the stock, or 0.01, so it moves a penny for every dollar that the stock moves. A very small move can, make some difference in the price there, and it's not necessarily insignificant. And then, yeah, so Vega was another one I think was mentioned here. Maybe not. Yeah. Vega measures price change due to volatility. So the Greeks are essentially, the option pricing model has a bunch of inputs. And what the Greeks do is, if you sort of remember algebra where you can change the equation around to solve for any of the variables, what the Greeks do is say, okay, well, let's assume all of these variables stay the same and solve for this one. So theta basically says, if all the pieces here stay the same, what is the effective change in time? Delta is, if all the pieces here stay the same, what is the effective change in price? Vega is, if all the pieces here stay the same, what is the change in volatility? And so, like the question asker said here, earnings are coming this Friday, so it's possible you could see implied volatilities getting higher as earnings approach. That wouldn't be out of line or necessarily unexpected. I mean, with a week to go, it doesn't seem like it would necessarily change a whole lot, but there's a lot of other stuff going on in the world, so it's possible that could have some impact. Where you will see a big changes, from Vega or in implied volatility in any case, are before and after earnings. A lot of times option prices will drop pretty drastically. If a stock reports on Wednesday, for example, Wednesday you may see a lot more premiums and they'll just drop with it, no change in the underlying price on Thursday because that uncertainty from what the earnings will be has gone away. That's a place where you see that. Row, yeah, especially an option that's super far out of the money and expires at the end of this week is, I mean, I said some of these were 0. Row is going to be basically nothing for something like this. It measures the options change in value versus a change in interest rates. And yeah, the interest rate input into the option is, or the time input, it has to do with the percentage of a year. And so yeah, the week to 3 days that we have left for this guy, a percentage of a year is, yeah, the interest rate aren't really having much effect there. And so supply and demand have some effect on option prices, but it's less than with a stock, right? Because the price of the option is tied to the price of the stock. And so what happens is most people aren't interested in owning an option at a range of prices, right? Like no one has a target price for an option that is independent from their expectations for the price of the stock. And so if the price of an option were to go way up or way down without any sort of change in the price of the underlying stock, that's weird, and essentially people just stop buying it, right? So the actual price of the option doesn't move much. It is possible, right? It's a market. It is possible for somebody to come in sort of in the short term. I know you can sort of buy up all the contracts that are for sale, and that will tend to send the ask a lot higher. You can, sell into all the bids, and that will tend to knock the bid down a little bit. And so you'll sometimes see, the spread widen in that case. And if you were to sort of calculate a hypothetical ideal price for the option, sometimes you would see the bid drop away from that. Sometimes you would see the ask, rise away from that. But in terms of supply and demand, it's not like a stock where people are like, oh man, I got to have this stock. It's running. Individual options don't run because they are tied to the price of the stock. So supply and demand do have some effect, but it's usually temporary and shows up in the bid-ask spread more than it does in the actual price. Another thing you may be seeing here in terms of prices changing at the end of the day, theta is pretty spread out throughout the day, right? I mean, you can measure it in days, weeks, hours, whatever, the time until the contract is no good. It's not like there's a meter running that clicks over and, Monday is over. And so now we're into Tuesday's theta as of, 3:59. That doesn't happen. You will see, and I've seen this a lot trying to run our portfolios here, is you'll see spreads widen into the close. And that's, I don't know. It could just be people canceling orders at the end of the day is kind of what I've always assumed it was, but I'm not really sure. Somebody who's actually been a market maker could probably tell you that a little bit better than I can. But that, if you're watching the midpoint and the spreads widen, especially, if the bid tends to drop more than the ask rises, that can look like the price falling at the end of the day. But there's no real reason for the price to just drop at the end of the day. It's not like all of the theta just gets removed at the end of the day. That's a pretty across the board process because it's the day happens as it happens. So if you got half a day left, then half the theta for that day should be gone at that point, more than it just all disappearing at once at the end. All right, so thank you to everybody who asked about rolling sold calls last time. I hope this was helpful, and thank you to Kavork for asking the questions about options pricing this time around. And yeah, that's all I have prepared. So any other questions anyone has? Questions about options, any of the slides we talked about here today, anything else you've found or seen on the website, all fair game. Just put them in the question box there, and I will read them out as they come in. One thing I do want to point out while we're waiting for questions is, as part of our redesign last year, we added a lot to our news coverage. We still have all the morning updates, stocks to watch, pieces that you are used to, hopefully. We try to highlight some of the longer pieces over here. That weekend review piece shows up here. The market week ahead piece on Monday is here. But we also partnered with a company called MT Newswire, and they provide market news at a level that we're just, have just been unable to do. So, they have these market news sectors. They do, or market news pieces. They cover a decent number of Canadian issues. And then they do some sector updates and also, broad market pieces throughout the day. Those are in the market news tab. And then you can hit here to get the updates for a couple of the individual sectors. Top stocks will be just all the news about some of the stocks from the categories from our stock page. So these are the stocks that have the highest overall scores. These are the sort of trending stocks, the things that are like most searched for on our website, things like that. Stocks where the scores have gone up a lot. Stocks that have reported earnings recently. And then we have these two news feeds here that we're pretty excited about. Insider trading activity. We even segment it out for buying and selling. The overall tab will actually include more than buying plus selling, because there are some things that don't necessarily fit into one of those categories, option exercises, maybe things like that. And then also analyst actions, so upgrades, downgrades, reiterates, price target changes, all of that shows here. And again, upgrades will show you all the upgrades, downgrades will show you all the downgrades. But like here, Goldman Sachs lowers price target for buy-rated Alaska Air Group. If they didn't change their rating, it's not an upgrade or a downgrade, even though they lowered their price target. So that's why those don't show up there. But yeah, this stuff is really good. It also, it also shows up on the stock pages over here. Oh, Goldman Sachs has a lot going on today. Yeah, so yeah, you can find that stuff there as well. If you're looking for news about Apple or whatever, any stock, it is on the thing there. And they cover, it's not just the mega caps. They cover an awful lot of stuff. It's pretty impressive how much content they churn out every day. All right, so here are some questions. Richard asks, is the use of trailing stops feasible? It certainly is, Richard. Depending on what you're doing. We don't do a lot of it here. We've been, an options shop for, most of our history, and it doesn't make a ton of sense when you're doing spread trading like we're doing to use a trailing stop. But certainly when you're trading stocks, it can work. There's a lot of different ways to do that. But yeah, if you're just buying stocks and hoping they run, certainly you can do that. Set it at some percentage, or there may be even smarter ways to do it. We had a swing trading product here, and we tried to set the stops, sort of on a trailing stop basis. Tried to set them intelligently in terms of, move them up to points where we didn't think we were going to get stopped out, but would still give the stock room to run. And we had some success with that at some points, and then really the volatility just made that. Yeah, the volatility made swing trading just less attractive to us altogether, because things will be down 5% one day and then up 5% the next day, and we got stopped out for no good reason. So yeah, that's why we're not doing that anymore. But trailing stops can certainly be a good way to try to limit your losses and let the winners run. So when you say trailing stops of naked calls, if you're just buying a call, you can do that. But yeah, depending on how long the calls you're buying are, I'm not, and by long I mean long dated. If you're buying leaps, maybe it makes sense. If you're trying to do short-term stuff around earnings, I'm not sure that makes as much sense. That's a pretty thing that I would probably want to be making the decision about when I was selling as opposed to just having a stop, because yeah, calls can be pretty volatile, so you'd probably want that to be a pretty wide stop. And you know, if you have a super wide stop because the thing moves around a whole lot, the stop ends up being a lot less protective than maybe some other things you could do there. All right, so Jose says, on covered calls, is there a high risk when there appears to be a large credit or low net cost for a trade that's not too far out of the money? About a month or two, perhaps expiration. So yeah, Jose, assuming I understand your question correctly, and please correct me if I don't. Yeah, I mean, option prices, like I sort of hinted at earlier, things with higher volatility will have higher option premiums. And so that's why if you look at, you know, microcap biotech stocks and things like that, they're going to have a much higher option premium as a percentage of the stock price than, you know, a big tech company or, you know, insurance, to use something that's pretty low volatility, as an example, right? So yeah, I mean, if you see a 2-month trade on like a $10 stock and you can get $4 for selling the option, it's probably because the stock is super volatile, and maybe there's an earnings date or something else in there as well. But yeah, it's certainly, there's certainly a reason for it. It's definitely, yeah, there's definitely a reason for it if you see something like that. Okay, and then two. All right, so this is a good question. Jose also has a question about our overall score and key rating. So let's go to yeah, let's look at this guy. All right, let's go back here. So our overall score shows up on the options trades. Well, it doesn't show up here, but it shows up in the options screener. The overall score really comes from here, where we have a lot of scores, and it combines the fundamental score and these two technical scores here. Valuation and analyst ranking, the pieces that go into that also go into the fundamental score. Yeah, stock sentiment is really a 5-day indicator in terms of being a looking back over the last 5 days. And obviously that's going to be somewhat included in both the short-term and long-term technical scores. But this is what the overall score is there. And really what that means is, in terms of our, you know, we try to be a relatively comprehensive system that combines some technical and some fundamental analysis. In this case, Goldman Sachs scores higher than 65% of stocks. So that's, call that top 2/3. The very top of the middle third, however you want to call that. That's what that means. And so that is an evaluation of the stock. Now the key rating is applied to the option trade. And the key rating, what we try to do here is, because we have the overall score, separate it from the stock evaluation, right? So if you want to know what we think about the stock, look at that overall score. If you want to know what we think about the option trade, that is where the key rating comes in. And so what we mean when we say we're looking at the option trade without evaluating the stock is, we're looking at sort of how well can you play defense with this position. And so something like this, where we're selling a call, what we're really looking for there is, how much premium are we getting for selling a call? What's the strike width at that point out in time, how far in or out of the money is the option. And so if we needed to roll that call, what are we talking about? So let me pull up an option chain here real quick. We'll go to Goldman Sachs. And that was a February 7. All right, so if I look at the calls here, the at the money options are, there's $3.77 in extrinsic value there, and the options are $2.50 apart. So that means I can sell more than one strike width of option premium at a time here. Whereas if I go to something, it doesn't have options anymore. Yeah, if I go to something a little more boring, here we're at, right, we've only got monthly options here, so there's fewer expirations to choose from. And then also the at the money option here is going to be, well, it's pretty much right between the two of those. But here we're selling $4 in extrinsic value, and the strikes are $10 apart. So if we were to try to roll this guy, we can bring in, $4 in extrinsic value, but we're going to have to move the strike price by $10 if we want to go up or down. That's a real hard position to play any sort of real defense against. Whereas, GS, where it's 377 on 250 strikes, that's a lot easier to move around and roll and do some things with that in terms of a covered call. So that's what we're looking at for covered calls and the diagonal spreads. And then the vertical spreads, we're really looking at the probability of expiration and how long the trade is. We're looking at how long the trade is also in all of these. So in most cases, you'll find that the lower keys tend to be longer trades. Some of that's because there are fewer strikes further out in time, and some of that is because, all things considered, we'd rather have a shorter trade. So yeah, 5 keys is not a guarantee. You can certainly lose on 5 keys and you can win with 1 key. But that is what we're doing there, is we're trying to give you an idea of how well we, how defensible we think the position is. Certainly if you went to the options screener, you could probably find 5 key trades on very low rated stocks. And you could probably find trades with very low keys on stocks that we rate very high. So it's really about sort of combining those two pieces of information together. And that was why we broke them out, because it didn't seem right to try to put analysis of the option trade in the way of like, how good a trade is this from a defense and management perspective. It didn't make sense to combine that with our evaluation of the stock. Especially when we added in the bearish strategies. So yeah, a 5 is going to be more defensible than a 2. Certainly, 5 is high and 1 is low in this system. All right, so I have a question from Todd here. Or hang on, let's get to Mike's question. Actually, Mike, what is the best way to use the option trades? Is a little broad. We have a lot of option trades in a lot of different categories. So, the portfolios are pretty much designed to be sort of taken as read. We send those emails out after the close. You can get it, evaluate the trade, do whatever it is you need to do before they open the next day. We provide a net debit there or a net credit as applicable. And yeah, we pretty much expect everybody to just sort of trade those using limit orders, and we will send guidance for whatever it is you need to do there until the position is closed. The investors keyhole trades, those come out 3 or 4 times a day. They're in your email. They also show up here. I don't expect anybody is doing 80 credit spreads a month. You know, if you are, that's fine, but yeah, that's not what I suspect is happening in any case. And so yeah, the idea there is there's always a trade coming. You don't need to try to adjust an old trade. You know, if you're behind on things, if you miss one, it's no big deal. You can do the ones you want and not do the ones you want. You can even, if there's a category that you like, you know, if you only want to hear about the insider activity, or you only want to hear about the upgrades and downgrades, you can toggle those on and off individually. Yeah, and then the, you know, featured trades and personalized trades, these guys here, those are trades that come from our screener. We're really trying to sort of highlight the, you know, some of the things we think are good today in those cases in a couple of different categories. And then yeah, the screener is there for you to do with as you want. We use the screener to, you know, help power some of the other products. And so it's a tool that we use and are trying to improve as we go along as well. Okay. All right. So now I'll get to Todd's question. Well, welcome aboard, Todd, first of all. And thanks for coming to the webinar. And yeah, so Todd's question is, he notices on the screener there are no basic straddles or strangles. And yeah, it's just because we've been focused on spreads. It's a thing we may add in the future. We added, when was it? Probably 2018. We went from just covered calls and diagonal spreads to having the vertical spreads and the condors and the bearish vertical spreads in the option screener. And so all of this is a work in progress. We may add straddles and strangles in the future. We may add, you know, the long only strategies as well. You know, it's conceivable we could even add some sort of screener for build your own things. It's really just a question of what we think is something that people would use and be useful to people, where we can we feel like our approach to things would be adding value. You know, some amount of this is just doing math, but we do think we have some. You know, we've been doing diagonal spreads in particular for a long time, and there aren't a ton of other option tools out there that are doing diagonal spreads. And so our analyst team was pretty proud of you know, being able to sort of write algorithms that can pick those as well as it does. And so straddles and strangles are just a thing we have less experience with. It's not to say we wouldn't do it in the future. It's just a thing where we'd have to really try to figure out what advantage we were giving people by adding that to the product. All right. That's all the questions I've got so far. We got a few more minutes if anybody has any more questions. This session, like all of our workshops, is being recorded. We'll send out a link to the video and also the slides, so you can download those and print them out if you want. Probably tomorrow or about midday or so is probably when we'll get that out. But yeah, and then yeah, 3 weeks from today is the 12th. So I will be talking to you again on February the 12th also. All right, so Todd has a follow-up about straddles and strangles. Do we feel like they're more risky, or does it just depend on the trade? I mean, in general, I think it really depends on the trade. Um, I mean, the thing that I find attractive about the strategies we have here are they sort of, right, and the condors is a little bit of an exception to that. But once you've done, yeah, once you've done credit spreads on the bullish side and the bearish side, it's pretty easy to put condors together from there. Whereas the straddles and strangles, they're certainly trades I've seen, setups where it's like, oh, that seems like a good place for a straddle or a good place for a strangle. But yeah, I mean, what we try to do here is really, sort of try to focus on having as many winning opportunities as possible. And so if you think about if you buy a stock, right, 50% of the possible outcomes, right, if you buy a stock at $50, it can go up or it can go down. And assuming it's random, right, like 50% of the time it's going to go up and 50% of the time it's going to go down. So that's a 50-50 strategy. But if you can have a $50 stock and have a cost basis of 49, well, now the odds are in my favor a little bit more, right? Because it can go down a little bit, or it can stay the same, or it can go up, and I make money in all of those situations. And so you have straddles and strangles. There's I feel like a much narrower set of circumstances where they make sense than some of the strategies that we're using, but they're certainly people are doing them and making a lot of money with them. It's just not a thing that we've spent a lot of time on here. That's all. Yeah, I'm not sure what you mean, Richard, by IV rank. We don't have, it's not part of our stock ranking system. Implied volatility is essentially a measure of how much move the options market is predicting, and it can change from option to option and from expiration to expiration. You see there are people now offering what they call volatility surfaces, where they've mapped out all the implied volatilities across the various expirations and strike prices, and you can see, it's not linear, and some of that's due to some of those supply and demand things we were talking about earlier in terms of option pricing. So you get kind of an interesting shaped plane, if you will. But yeah, we don't do a lot with implied volatility here, just because it's if we were doing long options or straddles and strangles, some of those things, it plays in a lot more. But the particular option strategies we have here, IV is just a little bit less relevant than some of the other things that we prefer to look at. All right, well, the number of questions coming in has been great, but it does seem to have slowed down. As always, you don't have to wait for these things to ask questions. You can find our phone number at the bottom of the page. It's not a good page to try to find the bottom of. It's right there. You can also hit this help button and send us a ticket. We get back to those pretty quick also. Either one of those is a great way to get in touch with us and have your questions answered. If you have a specific question in the middle of the day and you just need it answered right away, by all means, reach out. But these are certainly great places to answer, the sort of questions we're talking about today in terms of like, how does the website work? Some bigger questions, if you will. So yeah, thank you all for coming today. We'll send out this recording tomorrow. Thank you for subscribing to Investors Observer, and I hope to talk to you soon.